Hey, good afternoon. Happy Friday, May 20th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. All year long, we've been talking about inflation, and that inflation is the reason why mortgage interest rates are headed sharply higher. We know inflation's at a 40-year high. We hope we have just hit the plateau. But I have been particularly critical of Federal Reserve Chairman Jerome Powell and really other members of the Fed for also roiling the stock and the bond markets with their hawkish comments. This is a little bit like telling someone you're getting ready to hit them and assuring someone, hey, I'm getting ready to hit you, and hey, I'm going to hit you really, really hard, and then eventually hitting them a little bit. There's all of this bracing for impact. And if you're a bond trader and you're out there trying to position your portfolio or position what you're responsible for in preparation for what the Fed's about to do, boy, there's no wonder why we've been selling off in terms of mortgage-backed securities and interest rates have been heading higher. The Fed every single week keeps giving us these indications of how tough they're going to be on inflation. Let me show you a little bit of what I'm talking about, because this week was a good microcosm of exactly what I've been referring to. Here are the past 5 business days. 4 out of the 5, pretty good. Mortgage-backed securities actually increasing in value, which means interest rates are headed lower. Tuesday, the outlier there. Tuesday, May 17th, we saw mortgage-backed securities sell off rather precipitously. Due to what? Let's dive into what happened on Tuesday. And you can see we got a report Tuesday morning, 8:32 a.m., that retail sales came in a little hotter than expectations. You would think that would be bad. Really, the market shrugged that off. We didn't see a big sell-off in mortgage-backed securities early. It happened late in the day. So what happened late in the day on the 17th was this. This is Federal Reserve Chairman Jerome Powell sitting in front of a microphone saying they will not hesitate to keep raising rates until inflation comes down. That was, in a word, unnecessary. The Fed has said that many, many times before. Everyone already knows that. To say it again is a little bit like piling on after the referee has blown the whistle. But even worse, let's take a look at some more comments down here. Quote, if that involves, meaning if raising interest rates, if raising interest rates involves moving past broadly understood levels of neutral, we won't hesitate to do that. First time we've heard that from the Federal Reserve Chairman, and that, my friends, is why you saw mortgage-backed securities sell off late Tuesday afternoon. No new data, no new reports, simply the Federal Reserve Chairman sitting in front of a microphone saying, if we have to go past neutral, that's what we'll do in order to bring inflation down. Now, the whipsaw that mortgage-backed securities have been going through occurs because of something like this. Here's what happened the very next day. The Fed Chicago head Evans, this is Evans, his name is Charles Evans, spoke immediately after that and said that he expects to begin talking about just a 1/4 point hike in interest rates in the federal funds rate by July. So July, which everyone's already pricing in about a 1/2 point Fed funds rate increase for July and August. Now we're saying, for July, June, July, and August, is that now we're just going to maybe be talking about a 1/4 point rate increase. As a matter of fact, we don't know how much higher we're really going to need to go. They think that the neutral rate may come sooner than later. Evans said on Tuesday he supports moving to a shallower rate hike path by July and September to allow the Fed time to assess inflation and the job market as it pushes up borrowing costs up to neutral and likely beyond. So there you go. You have the Federal Reserve Chairman talking about how tough they're about to be. They're willing and ready to go past neutral to get inflation under control. They will not hesitate. That's what he said. Then you have the Chicago Fed saying, hey, I think we're just going to be at a 1/4 point come July and September. And then I advocate that we pause and look at assess inflation, give it time to manifest itself and see where we are. All of these bond traders that are in charge of mortgage-backed securities are looking at this information, and that's why you see big sell-offs on one day and big bounce-backs on the next day. It's this dialogue that's coming out of our Federal Reserve that creates the turmoil that we see in the bond market. It's also creating some turmoil in the stock market. All of that means that you really are day to day in terms of how interest rates are performing, and it makes good sense to be sure you're talking to a lender who's watching these dynamics and knows, hey, on Tuesday, let's avoid locking in. It was just comments by someone in front of a microphone. Let's give this time to settle out. All of that could result in thousands of dollars worth of savings for you, be it in closing costs or in annual interest on your mortgage. If I can be of any service to you, please don't hesitate to reach out, mark.milam@highlandmtg.com. Thanks.